Good afternoon and welcome to NCOIL Special Committee on Race and Insurance Underwriting. And we are now, some are in distance and some are in Charleston. And it is Thursday, April 15th at 2:30 p.m. And I call the meeting to order. Then I ask any legislators on Zoom if they can identify themselves and what state they're from.
It's Jim Gooch from Kentucky.
Edmund Jordan, Louisiana.
Kevin Cahill, New York.
Wendy Thomas, Pennsylvania.
Thomas, Pennsylvania. Anyone else? Okay, Will, if you would introduce, is there anyone in the room from Charleston?
Yes, Mr. Chairman, we have Ohio Senator.
I'm
Bob.
sorry, Will. Can you hang on a second? Folks, we have an unacceptable noise level in the room, and I'm going to ask you if you're having a sidebar conversation to take it outside. If you'd like to stay inside, then have no sidebar conversation. Thank you. Go ahead, Will.
Thanks, Tom. Yeah, we have Ohio Senator Bob Hackett, Kentucky Representatives Joe Fisher and Bart Rowland are here. I saw them just step out momentarily. They will be back. And also we have Rhode Island Senator Roger Picard.
Great, thank you. I'm delighted to see everyone. I'm just very sorry I am not there with you. And I see with Kevin Cahill here holding up New York. We've just gone through a very stressful budget that ended up with $212 billion in the budget. But at the same time we were doing that, we were trying to find out how much we were getting from the federal government that would attack our $15 billion deficit. We had a speaker who came down with the virus. We also have a governor that had other difficulties around him. And so it was a very difficult process. Once the budget was over, unfortunately, I am the co-chairman also of legislative ethics in the New York State Legislature. And I found myself with not many problems, but problems that needed to be addressed fully and quickly. So I am in Albany, and there's no place I would rather be than in Charleston on a beautiful, beautiful day. So with that, I'd like to begin the operation. I also wanted to recognize that because our new leader in Indiana, our current president, also has additional responsibilities in Indiana. And President Lehman and I just go way back in NCOIL politics and NCOIL governing. No one ever identified close similarity in our, I guess, our favoritism in politics. But at the same time, I recognized President Lehman as one of the brightest and most capable committee chairs we've ever had at NCOIL. And I was delighted to see him finally arrive at president. And I'd be remiss if I didn't speak out about Kevin Cahill there, who has been a terrific legislator in New York and on his way to become president of NCOIL. It's great to have him as a friend. And he's also the chairman of insurance in the assembly, and I have a similar position in the Senate. So, and there's so many others in the audience right now who are special friends. And again, it's unfortunate that I am in Albany and some of you are in Charleston. I think we had a great session in, I think it was December, so far long ago. I think it was December, but it's incomplete. Hopefully this, with the number of distinguished speakers, we shouldn't have a problem with completing our task, after which hopefully the committee can quickly later, can arrive at some conclusions and some recommendations. And I'd be remiss if I didn't mention the fact that there's now federal legislation trying to, I think, improperly intrude on our responsibilities as a state-based operation. And as you know, over the years, it generally crops up that the federal government says, I'm going to stick my head in here and do some things that are inappropriate to me under existing law. And from a practical point of view, not well served. And so relative to today, today's format, we'll hear from our speakers, then it'll open it up for questions. We'll take a 10-minute break from the remaining speakers, followed by more questions and committee discussion. If many of you know, when I served as a chairman of a committee, I tend not to be involved in the discussion because it moves it on at a quicker pace, and we're more likely to finish on time. I'm trying not to participate directly as some others choose to do. So the first speaker on our agenda is David Eccles, who is a PhD in risk management and insurance program. He's also a professor of Terry College of Business at the University of Georgia. Professor, the stage is yours.
Mr. Chairman, just one quick thing before Professor Eccles begins, just an update on attendance here. South Carolina Representative Carl Anderson is here in Charleston, and also on Zoom, we see that New York Assemblywoman Pam Hunter's on now, and also Michigan Senator Lena Thies. I don't know if there's any other legislators on Zoom that weren't here in the beginning.
And I would be remiss if I didn't single out Pam Hunter, who's done a phenomenal job in the New York State Assembly, a dear friend who I tried to call the other day. So Pam, I hope, are you in Charleston or are you remote?
I am in Syracuse.
Oh, that's a little town west of Albany?
Absolutely. It's 144 miles.
Welcome, welcome. Okay, we're again ready to start. Professor?
Thank you, and thank you for the invitation. I'd like to thank Tom and Will for inviting me here today. I believe my goal is to just sort of set the stage for the discussion today. And so in that vein, hopefully I will do exactly that.
If you could speak up, or we could turn the volume up a little bit.
Is this better?
Yes, a little bit, yeah.
I usually yell in class, but I don't know if I don't have a microphone, so I don't know if I need to yell into the mic or hopefully this is okay. If you can't hear me, let me know. Or now if it's too loud. Yikes. Okay, so at any rate, this is obviously a very important issue, and I appreciate the opportunity to lend at least some voice to it, and again, more of a table setting role. Maybe. You can click through them if you want. That's easy. Thank you. Yeah, so when I was asked to sort of, again, set this sort of table, I came at it from sort of two perspectives. One, from your perspective, you know, what is sort of the usual rate making concern of legislators and regulators. And these are all things that you've seen before, right? That the premiums or rates shouldn't be excessive, they should be adequate to cover the losses. And importantly, for this discussion, should not be unfairly discriminatory. From an economist perspective, which is where I come from, we think about these same things, but we think about covering the expected losses, the costs associated with them, any sort of buffer we might need for rainy days, and of course, for stock companies or companies with a profit motive, profits. And sort of in theory, anyway, if we have a really competitive market for an insurance product, that should, in theory, drive out discrimination, right? So discrimination shouldn't really be a problem if we have a really competitive market where this would sort of take care of itself. But of course, that's a bit naive, and that's why we have you guys and includes discussions around these. And so Where does discrimination come into rate making? Well, in sort of broad strokes, rate making in some way is inherently discriminatory, right? So insurers go out and try to figure out what are the factors that are related to either the frequency of a loss or severity of a loss, and they try to identify these factors. And they can be, your age, the kind of car you drive, where you live, these sorts of things. And some of these factors may indeed create what is oftentimes referred to as a disparate impact. So I think a really good example is for older individuals, right? So it's pretty clear that the older you get, the more likely is you are to die, and unfortunately, and so you have to pay more for life insurance if you want a life insurance product. But of course, this then creates this sort of quote unquote disparate impact for the elderly or for however you want to define old age. And so while this is sort of unfortunate, it is not sort of discriminatory in a sort of malicious way. It's just sort of a necessary outcome of the product that life insurers, specifically to use this example, are selling. And of course, from a regulatory perspective, you have to sort of balance these sort of real factors with those that are sort of discriminatory. And so that's sort of the rub, right? When you figure out, well, what is the difference between this disparate impact, or trying to separate disparate impact versus discrimination, or what the phrase is often used, proxy discrimination. So I think it's important to point out, number one, that these are not, at least in my mind, synonymous. Right. And so how do we define? So let's define, or how I would define disparate impact versus proxy discrimination. Disparate impact is a situation that results in a disproportionate effect, particularly a negative effect, on a protected class. While proxy discrimination might start off the same, right? There still might be a disproportionate negative impact, but there also is a very important second part to this. And that is that the big reveal eventually. You see it's stuck. There we go. All right, I won't try to go back. The factor that is identified, again, in the case of an insurer, is sort of intentionally used as a substitute for the protected class. So they're not using it, it's not being used to, just sort of appropriately price insurance in this case, but rather to specifically and intentionally discriminate against a protected class. And of course, as you can imagine, one of these is sort of easy to figure out, or relatively anyway, easy to figure out, while the other is not so much. So it's pretty easy to see this result with respect to disparate impact in sort of the first half of proxy discrimination. Is there an impact on a protected class? And again, if we just go back to the simple life insurance example, yeah, the older people are going to pay higher prices or higher premiums. The question then is this rating factor being used sort of intentionally to substitute to discriminate against these, in this case, the elderly? And again, this is very difficult to do or to prove anyway. Yeah, in that way, it's this is an unenviable task that you guys have. So when it comes to your role or the role of the legislators and the regulators working together, and I think it's important to remember a couple of things. One is that while this disparate impact may exist, you can solve that problem, right? So you guys can solve that through legislation, say, well, you can or cannot use these certain rating factors, and that's sort of relatively easy solution to make. The proxy discrimination, on the other hand, is sort of, you could think of as already under your purview, right? So as we started this discussion, one of the original reasons and goals of a regulator, a legislator working in tandem is to minimize unfair discrimination. And so, and that would be proxy discrimination. So in some ways, this is something that's already done, right? Or at least intended to be done, but is oftentimes confused. And in fact, until recently, undefined sort of this idea of proxy discrimination. And so that's what the, part of at least the amendment of the Modernization Act, the Property Casualty Modernization Act, is intended to do, is to sort of provide this a definition of proxy discrimination. And so that essentially concludes my comments, but I'll sort of leave you with one last sort of reminder, and that is, again, that it's not, the proxy discrimination and disparate impact are not the same thing. So it's important to not equate the two, and to remember that disparate impact might be an unfortunate consequence, but it can be solved, right, through the regulatory process or the legislative process. Whereas proxy discrimination also is unfortunate and is not good, but it is harder to figure out and is already sort of under the purview of the legislators and the regulators. Those are my comments. Thank you for your time.
Thank you very much, Professor. Okay, we will take questions after the first group. We'll move on to the second speaker, who we've seen before, and that's Peter Koechenberger, who's the Executive Director of Insurance and Law and Deputy Director of the Insurance Law Center and Associate Clinical Professor of Law at the University of Connecticut Law School. Professor, you're on.
Thank you very much. I think I can share the screen. Yes, I hope so. I'm sorry, I just wanted to put the PowerPoint up.
It's okay.
Is it up now? I think it's up.
Yes, yes.
Thank you. Okay, thank you. Sorry about that. So good afternoon. As Senator Breslin said, my name is Peter Koechenberger, and I teach at UConn Law School and help run our Insurance Law Center. It is a pleasure to be here, and I appreciate the invitation. Although, of course, when I say here, just as mentioned earlier, I was in Charleston now very much rather than Connecticut, where it's raining, and we will have snow in a few, probably later today. So at any point, I would, depending on what, the preference of the moderator in the group, I'm happy to take questions throughout this time. The topic I have is one aspect in part of disparate impact analysis, unfair discrimination in rating and what that might mean. But it's also discrete from that as well. And that's the insurer's use of criminal history information. And we know a couple things. One is, well, three things. One, it's been used for a long time. Two, this information, criminal record history, is increasingly available as jurisdictions, local jurisdictions, even state, the information, while perhaps public in a legal sense, was not accessible in a real sense. And that's often and increasingly not true. So this information, criminal record history, is increasingly available. And then the third trend, and this is part of what we've all been talking about for years with big data, predictive analytics, it can be used. Not only is it captured, it is used in more ways, more sophisticated ways, and ones in which many of us, perhaps the large majority, are not sure how. These are some of the examples of companies: LexisNexis, TransUnion. These are, I think, very familiar to us. I don't pretend to have an exhaustive list, either in my file or certainly not here. It's somewhat surprisingly difficult, I found, to at least get even a sense of how criminal record history is being used. Professors don't have subpoena powers, which is probably a blessing for the rest of the world, but always a little frustrating for us. So two issues to focus on, and I'm going to focus on. One is simply as an example. Is this information being used accurately? In other words, first, at a fundamental level, is the criminal record accurate? Is it a mistake? Is it someone else? But more important for our purposes, second, is criminal record history. It's not static. It changes. And how are those changes captured in a underwriting or claim model, if at all? And then the second major issue is really, should criminal history records be used at all, with definitely some narrow exceptions, be used at all, given some of the problems we'll talk about, but also given the rise in other risk factors. We read all the time, and increasingly so, about the increasing number of risk classifications, the use of non-claim data, non-underwriting data, social media, shopping habits, to create a predictive risk model. And given this, would there in fact be any measurable loss of effective or necessary risk prediction if we stop using criminal data? So for the first, it's just a discrete issue to consider before we go into the larger, and that is arrest and conviction records, as I mentioned, are not static. An arrest record, the charges could be dropped, the defendant could be acquitted, or even if there's a conviction, there are, and while it varies by state, every state has a variety of ways in which a record can be sealed, a juvenile record, for example, but also, if it's ever even open, but also accelerated rehabilitation, often for minor crimes, minor drug offenses, in which that record is considered by law no longer to exist, except for some limited purposes, which do not include, as far as I know, insurance or underwriting. So what happens? And this is simply a diagram that sort of hopefully illustrates this. And that is, all right, so the search engine, whatever we want to call it, finds a criminal record. Peter's been arrested. Doesn't have to be a conviction, can be an arrest. Let's say either Peter pleads guilty. But the nature of the offense is such is that Peter is given a fresh start, and the record is sealed or erased, depending on the state, and cannot be used. Well, it was an accurate record here. It became unusable in theory, well, in law, and in theory, but perhaps not in practice, once there's a fresh start, or substitute for fresh start, once the fact that if I'm acquitted or the charges are dropped. But what happens then? So the record is caught and used here. Let's just use the fresh start, or the record is sealed. It will, in fact, the protocol detect the search engine, the absence of a criminal record, and modify my profile. So once with the arrest and potential conviction, I'm charged more. I have many negative things in my going on right now, obviously, but I'm charged more, presumably, for credit and for insurance. But now the record's sealed, and the idea of the fresh start is that it doesn't affect me anymore, affect the person. And does the initial criminal arrest simply exist for the rest of my life to be used in model after model? Is in fact the model that captured it, or models, because there's more than one, changed? And does it make a difference? It increasingly does, of course, because we know, and I have certainly plenty of information, and I'm sure many of you do have more, on the effects of a criminal record on employment, education, income, many other areas. So it matters how my records are being used. And do we in fact know, do we know how they're being used? And by we, it's not so important that I know. It's important that the individual knows. As a consumer, I know, but it's really important that insurance regulators and legislators, state legislatures, know how this is being used, because there's no otherwise. There's this issue, the use of these records and how they're used operates not out of any evil intent, but operates in darkness. And that is increasingly a problem. The bigger issue, as I mentioned at the start, and this is the second issue though, is that should the criminal record history be suspended or used, should they be used at all? And we know a couple things. One is our criminal justice system in the United States, and by that we start from with the police all the way through the prosecutors, the defense, the courts, the parole and prison system throughout. We have a very harsh system. I'm not going to whether justifiably harsh often or not, but compared to the rest, many areas of the world, in terms of the numbers of people arrested and incarcerated, it's quite large. So we have the fact that criminal history data is being used more often. It may be being used in perpetuity, that our system overall generates a significant amount of arrests and convictions and imprisonments, along with the fact that we also know that there's a disproportionate effect on different groups, particularly by race, although not exclusively. Just quickly, some background information. Over 10 million people, or 10 million arrests in 2019, according to the FBI. However, some people were arrested more than once, so the number might be actually lower. However, again, this is 1 year. Each year, the numbers have been roughly similar. They've gone as low as 7 or 8 and up to, I think, 11 or 12. But the point is, and this second point is not my guess, certainly, but is an estimate, because there's no clear record, but that, and I think it's extraordinary, 1/3 of adult Americans, not adult of any specific group, but overall in our country, 1/3 of adult Americans have a criminal record, which can be an arrest or conviction. The point I have there does not include infractions, traffic offenses, and other violations. Normally it would be, who cares? And we typically would never care that much after we pay the fine. But these things are also being caught in search engines and being utilized, presumably not as serious as a felony, but being utilized in risk classifications. And the disparities by race are not only in arrests, but also in these minor infractions. And that's been documented in a number of cases. The world, I apologize, it's not easy to see. The world prison population total, we're well above any other country. The 4 below us, China, Brazil, Russia, and India. With due respect to each of those countries, and not countries I think we'd want to model or be compared to our criminal justice system, yet we imprison more. And there's problems with all these numbers in terms of reporting, but nevertheless, it is stark. And then simply a snapshot as of last week of federal prison population by race, with African-American Black inmates more than or double or triple the population. So just to go back very quickly, just to think about this again. So this is a problem not simply because of the fact that there's disproportionate police or criminal justice system that disproportionately arrests and incarcerates African Americans or other groups. That is a significant problem, but it's also a problem for all of us, again, with the fact that 70 to 100 million about 70 to 100 million Americans are estimated to have a criminal record. We also know, sorry to go back, we also know that just simply some points on the disparate nature of criminal record history. The records, and nothing can be neutral. Police records, police actions, court actions, judicial actions can, in fact, often, not always, but often are, not even if not intentionally, but are biased and disproportionately affect the poor, affect African Americans and other people of color. And this is something that is not new to our country. It's endemic to it, but more importantly, it's become much more apparent. And 2020, and of course the death of the trial continues this week on George Floyd. So simply some examples. The quote from the CDC, the Center for Disease Control, is simply to know that it is not simply, the effects are beyond the period of incarceration of the person who's arrested, beyond insurance, beyond employment, but also significant health effects. So this is the main point of the slide. I'm sorry, really the question, and it is a question, it's not, I don't mean it to be rhetorical. The insurance industry, and a better term would be sector. That's all of us, the insurers, producers, agents, brokers, regulators, legislators, third-party administrators, the few academics that work in this area, I think a good number of them who are speaking today. What is our responsibility? Well, we can't solve those underlying problems, and nor should we be paralyzed, I think, as unfortunately some industry have suggested very recently, in the sense of let's just study it before we understand. But we can And then we can, I apologize if it's too much of a cliche, but take care of our own pets. And by that means we can do something. And we can, first of all, understand exactly how it's being used. And secondly, restrict it to only those areas where it's absolutely necessary, or where the nature of the criminal offense, the arrest or the conviction, the nature of the conviction is specific to the type of risk being underwritten, so convictions for insurance fraud, for example. So nothing's absolute, and I don't suggest this should be. And while legislators can, one area can be legislators evaluate and then regulate through legislation, or and to some extent allow, whatever balance between regulators and legislators, but legislators limit or eliminate the use of, or specifically identify how criminal records can be used. In other words, a prescriptive approach, and that may be necessary or appropriate. But I have a more limited goal, and that is to work with the industry, and given these facts that we've talked about, is to see if the industry would voluntarily suspend the use of criminal history data for several years in personal lines, both so this issue can be studied without potentially further harm occurring, and also to see what effect on markets does it have. I suspect, and I'm not an actuary, that it would have very little, given the other risk factors we have. But the value of doing so, I think, is significant. And with that, I thank you for your patience and time.
Thank you very much, Professor. Moving on, the next presenter, Julia Angwin, is the editor-in-chief of the Markup.
Hello. Am I doing my slides, or do you guys have somebody doing them there?
We should be putting them up in a second, I would expect.
Julie, in discussion with your staff, you were going to share your screen.
Oh, okay. I'll do it. It's fine.
Thank
Okay. Can you see my screen?
Yes.
Okay, great. So it's great to be here. This is not my normal forum. I'm a journalist. I don't really usually appear at these kind of events, so I'm honored to be here. And I'm mostly going to just be talking about the coverage I have done of race and insurance underwriting. I'm at a nonprofit called The Markup, but the work that I'm going to talk about here is something I did when I was at ProPublica a few years back. So this was a study of insurance pricing and the fact that it varies by zip code. And there have been a lot of anecdotal concerns for years that minority zip codes were charged more, so that the same safe driver in a minority zip code would have a higher insurance premium. And the question was that really justified by risk? And that had not been answered as far as I know. It had long been observed, right, that there were these differences and that it primarily impacted communities, Black and Brown communities. So I decided at the ProPublica, I led a team where we decided to see if we could figure out whether these price differences were truly justified by risk. So what we did was we went and got quotes by zip code for multiple insurance companies by zip code and bought them from this company Quadrant, along with our partners at Consumer Reports. And we used those quotes and we compared them to the risk data that we could find. What we did was we filed public records requests in all 50 states for liability payouts per zip code. Only 4 states gave us that data. Other states said they did not keep that data. And so we were able to do this analysis just for California, Illinois, Missouri, and Texas. And then what we did was we compared what the payouts were per zip code and what the premiums were per zip code to see whether there were disparities. And we did this for one single driver profile, just to make it a consistent comparison. So it was a 30-year-old female teacher with a bachelor's degree, and you can see the details here. And so we looked at those policies from various insurers in all of these different jurisdictions. And so we came up with these kind of incomprehensible charts that you can see, that we publish. You're welcome to dive into them, but basically they showed the ratio of the prediction in minority neighborhoods versus non-minority neighborhoods. So when you see something that's over 1.2, we consider that, you know, basically a 20% difference between the minority and non-minority neighborhoods. And those are ones that we thought were worth looking at. So we charted them for each and every company per state. So it was a lot of charts, but what you can see that most of all the charts looked kind of like this. So essentially you saw that the payouts on the the payouts were on the x-axis. So that's how much insurers were paying out per zip code. And the premiums were on the y-axis. And so what you see is a pretty straight comparison in the minority neighborhoods, that's the red, where it's a pretty linear progression that as payouts go up, premiums go up. So that's something you would expect to see. What you don't expect to see is what we saw in the whiter neighborhoods, which was that payouts started to decline in these the premium started to decline in the higher payout areas. So even though claim payouts were higher, for some reason, premiums went down towards that far end of the range. And that was pretty consistent throughout all of the places where we saw disparities, that there was this strange decline in the whiter neighborhoods. And you can see, by the way, I have a link here, but I'm sure most of you can look it up, that we put out all of our data and our charts, and you can see all of them on this ProPublica link here. And I just want to tell you what that looks like for a real person. So this isn't just a theoretical issue, right? So I went to Chicago and did some reporting about how this affects a regular person. And this is Otis. He was paying $190 a month for Geico. He had no accidents, completely safe driver. But he lived on the west side of Chicago, which is, you know, a heavily Black neighborhood. And his rates were much higher than Ryan, who lived across town in the west, right near Wrigley Park, but had an accident. And he was only paying $55 a month, which was surprising. It was also Geico. And when I looked deeper into their rates, you could actually see that it was the property damage base rate was the difference. And in Nash zip code, in Otis's zip code, the base rate was $753 a year for the premiums. And in Brian's neighborhood, in the whiter neighborhood, the base rate was $376. So that was a huge disparity in the base rates. But actually, the difference in payouts was completely minimal, right? It was a $12 difference in payouts over a 3-year period in those two areas. And so that's sort of just a difference in risk that was just unexplainable, and was consistently penalizing minority neighborhoods. And so those are the findings that we had in that story, which I think raised the question about whether the use of zip code really is justified, because it doesn't seem like it seems like it's actually pricing in something other than true risk here. And it seems like it's being used to identify minority neighborhoods and to penalize them in many cases. So that is the story that I did at ProPublica. I'm happy to answer questions about it. As you may or may not know, California did require insurers to adjust the rates after our story came out. I don't think there's been action in the other states that we wrote about. After leaving ProPublica, I started a company, a new newsroom, The Markup. It's a nonprofit also, and we cover the impact of tech on society. And we actually started, I'm going to just briefly talk about the first story we launched with was also an analysis of insurance. So I'm sort of obsessed with car insurance. So we looked at Allstate's algorithm. So Allstate has an algorithm that actually attempts to what they call, it's a retention model, they call it, which is basically to price in whether people are likely to switch to another insurer. And so they add this retention factor at the end of their analysis. And we found a filing in Maryland where they actually described how this retention model would impact every single ratepayer in the state. And we were able to reverse engineer the algorithm. And we showed using decision tree that it was actually a really interesting algorithm. It basically looked at how much you were paying. So if you're paying $1,900 or more, they assumed that you were indifferent to price and they gave you a much higher rate increase. And if you're paying less, they assumed you were more price conscious and didn't give you as much. And the reason I bring this up in this meeting is because there was a race impact. This is just the difference in prices, but basically the higher rate increases primarily impacted middle-aged people, men, and communities that were non-white. And so even times when there are disparate impacts that affect things other than race, I thought it was just worth noting that race is often one of the factors that is affected when you put together these complex models that basically are not related to people's actual driving. So that is it. Thank you very much.
Thank you, Sanguine. And the final speaker in the first group will be Daniel Strigberger, Strigberg Brown Armstrong.
Thank you. Good afternoon, everybody. It's a pleasure to present south of the border, although I am up in Waterloo, Ontario, where we are under pretty much a full lockdown here. So I'm sitting in my dining room. Pleasure to address this group. I do not have a PowerPoint. I'm going to be talking basically to you about interesting developments, I guess, so to speak, in Canada with respect to underwriting for auto insurance, specifically in using issues such as age and marital status and sex to determine underwriting premiums and stuff. So just to give you a little bit of an overview, in Canada, the human rights law at a federal level, national level, is contained within a document called the Charter of Rights and Freedoms, which is it was a constitutional amendment to the federally, and it went into force in 1982. And basically that charter guarantees human rights and freedoms and the like to all Canadians, doesn't matter what province you're in. And the only catch, so to speak, is that it's only with respect to involvement or incidents with federal or provincial agencies, governments, and so on. So including police departments, anything that's where a federal or provincial law infringes on one's rights, then that's dealt with in the charter. At the provincial level, and in Ontario specifically, human rights law is contained in a piece of legislation that's known as the Ontario Human Rights Code, and it provides protection to all residents of Ontario, all people in Ontario, the right to not be discriminated against based on various protected grounds, which include age, ancestry, race, citizenship, family status, marital status, sex and sexual orientation, and there's a list of other criteria as well. Now, like most pieces of legislation, both the Charter and the Ontario Human Rights Code have exceptions, so to speak. And the one that's contained in the Ontario Human Rights Code deals with reasonable and bona fide grounds for the act of discrimination. And I'll give you an example shortly when I talk about one of the big cases in Canada dealing with this issue. Now, just to give you a quick overview of auto insurance in Canada, basically, some provinces in Canada have a government insurance. So there's basically one auto insurance company that provides all the third party liability and any first party benefits and property damage and all that. And that anybody who has a driver's license or vehicle registered in that province is automatically enrolled into those policies with the one insurer. Now, those aren't as interesting as the other ones, the other provinces, including Ontario, Alberta, and some others. Basically, it's private insurance companies like your Allstate, your Travelers, etc., who are responsible for insurance. Basically, when I say responsible, I mean those are the companies that sell auto insurance in the province. Now, auto insurance is highly regulated at the provincial level. It might be next to life insurance as well. Probably the most regulated kind of insurance. And every company, it doesn't matter which company sells in Ontario, but it has to sell a standard auto policy. So it's basically a one size fits all policy that is standard across the province, and it has the policy is written by the our superintendent of insurance, and it has mandatory first party benefits, third party liability limits of a minimum of $200,000 and a couple other coverages. Now, insurers who are selling these products have their underwriting, rating, and classification systems approved by their respective regulators, and they have to file these underwriting guidelines periodically. And then insurers usually determine risk classification based on various factors, including obviously the type of vehicle it's being insured, the location of the vehicle, and the drivers of vehicles. And so I'm going to be focusing obviously on the drivers of vehicles. Now, in Ontario, there's no legislation basically says that no element of a risk classification can use several factors. For example, an insurer that is classifying its risk and writing a policy cannot determine premiums based on the insured's income, employment history, credit rating, and physical or mental health. However, note that there are no prohibitions against using factors such as age and sex. Now, this takes us to a Supreme Court of Canada decision from 1992, I believe. The case here is known as Bates and Zurich Insurance. And what happened here in Bates was the insured, Mr. Bates, was under the age of 25. He was a male driver and he was single. And he brought a discrimination matter under the Ontario Human Rights Tribunal against Zurich Insurance, saying that he was being discriminated on because he had to pay a higher premium for essentially being under 25, male, and not married. He made a comparison to young single female drivers, young married male drivers, or any driver that was above the age of 25 who was not charged any different premium just based on those criteria. So he basically alleged that there was a denial of his right to contract with the insurer on equal terms without any discrimination, and of the right to equal treatment in the kind of services that he was trying to obtain. Now, interestingly, the insurer at all levels of the dispute conceded that their practices were most definitely discriminatory. So there was no issue that they were discriminating based on age and sex and marital status, but they argued that this was one of the the exceptions. And the code says that there is an exception, and that I guess you're allowed to discriminate if it's based on reasonable and bona fide grounds. So a rate classification system, for example, which discriminates on the basis of prohibited group characteristics, is reasonably necessary to ensure the efficient operation of the insurance system. And this is what the insurer was arguing. So it went to the tribunal. The tribunal held that it was discriminatory, and however, it basically held that the whole thing was discriminatory. It made its way up to 2 appeal levels, and at the Supreme Court of Canada level, the court was split. There were 7 judges hearing it. Our court has 9 judges, but sometimes only 7 will hear cases. 5 of those judges agreed with the insurer that it was discriminatory, but held that it fell within the exception provided, meaning that they were doing what they were doing because there was no other way to basically collect that kind of information and to assess risk for the group that they were assessing. A considerable portion of the analysis was devoted to the availability of having a practical alternative. So for example, the court concluded that at the time the complaint was brought, there were no practical alternatives to rating drivers on these discriminatory grounds, such as age, sex, and marital status. And recall that the complaint, this case came out in 1992, but the actual complaint was brought earlier. It was in the mid 1980s, and the court said that this did not mean that there would never be practical alternatives. The court said that the insurance industry must strive to avoid setting premiums based on these grounds that they're not allowed to, and sort of left the door open for someday there being a practical alternative to determining premiums, for example, for male drivers who are under the age of 25 and single. Now, this was met with a dissent by 2 judges, and those judges held that there was an alternative to using the discriminatory classification system. And basically, the way that they looked at it, they said the premiums of drivers over the age of 25 were set according to completely non-discriminatory classifications. So they held that given that there was this alternative to decide the premiums for people over 25, and there was no evidence, according to the 2 judges, that they could not adopt a similar rating system for people under 25. And so they held that they didn't agree that there weren't any practical alternatives. So where this takes us now is basically to the concept of now we're in 2021. And of course, are there any kinds of practical alternatives to determine these rate classifications? And what we're seeing more and more out here is the use of telematics and user-based insurance products. And so a lot of insurance companies out here are starting to offer drivers the ability to take this little, it's like a black box, I guess, device that you plug right into your car, and then it measures things such as your speed, your brake response time, and basically other things about your driving that I'm sure they don't necessarily tell us all what they're what they're measuring. However, it's offered to and sold to insured people as a way to pay lower premiums. And basically, if you drive better, then your premiums will reduce. Now, there's a problem with those little boxes in that they're plugged directly into the car, so they don't know exactly who's driving, right? So you could have several drivers in a household, and if one driver is a lousy driver, whereas the other drivers are good drivers, the insurer won't necessarily know which driver is driving, and so it comes with its limits there. So other insurance companies now are starting to sell or offer these applications for smartphones, where basically it isn't tapped into the car per se, but it does measure things such as speed and location and things like that as well. And I think some of these also talk via Bluetooth to other devices that you could plug into your cars as well. So they do talk to each other that way. So now, again, the question is this something that insurers can use as a practical alternative to determining premiums for certain groups who are otherwise or would have been discriminated by previously? Now, we looked at this, and I wrote an article about the Bates case and this issue back in 2016. At the time, there were no cases that had revisited that case with respect to insurance. Now we're in 2021, and there are still no cases that deal with it with respect to insurance. However, I do anticipate that this issue is going to come up again soon. Because of the fact that with the existence of telematics and technology specifically, that there must be ways to really focus in on drivers for rate classifications as opposed to just collecting everybody into groups. That's all I had today to discuss with you.
That completes the first round. So we'll open it up for any questions from the first number of speakers, first four. Any questions?
Assemblyman Cahill's hand raised.
Assemblyman Cahill.
Thank you, sir. And once again, Senator Breslin, thank you for your valiant effort in leading this charge. I think it's an important issue, and I thank you also for revisiting it. I would suggest, however, to the entire body that this likely is not the conclusion of this issue, that it is something that is ongoing. And that was a point that came home to me even more so when I guess it's Ms. Agwin was speaking. And Angwin, I'm sorry. And it appears that everything that we've experienced to date when actuaries were pencil pushers will be exacerbated, will be made magnified, multiplied even in the information age when there's so much more data that can be subdivided and used. And so that would bring me to my question to her. Do you believe, based upon your analysis, that the technological innovations of the last several years and the growth in the information that's available over the last several years will serve to make the problem of discrimination in insurance worse, or will it have no effect, or will it actually give us tools to ameliorate it?
Thank you for that question, and thanks for the kind words. I am really not a policy person. So as a journalist who's observing this industry, I would say that the thing that is so surprising to me is that that if you're trying to measure risk of an accident and whether you're gonna have to pay out for an accident, you know, a lot of variables just don't seem like they should be relevant, right? Like a zip code or whether you're likely to shop around for another rate. And so the inclusion of additional data like that shows discriminatory effects in my reporting, and the explosion of big data means that there's going to be more and more things like that, I think, included. But I would say that algorithms are adjustable and you can adjust them to do anything you want. And one thing that's really nice about the world of algorithms is that if you want to tune it and say, I want to remove racial bias, you actually can, right? And so it does give us an opportunity to do that. I'm not the person to tell you how that would happen, but I think it could go either way. But I do find it troubling when I see these variables being used in ways that are, it seems unintentionally discriminatory.
And that brings me to a question, if you don't mind, Mr. Chairman. I'll get all my questions out of the way now.
Now you're open floor. Go ahead.
My questions to Mr. Strigberger, and that is with regard to the exclusions that are written into the law. I heard you say income, education, mental and physical health. I didn't hear you talk about, did you mention race?
Oh, so with respect to the auto insurance regulation that in Ontario, with respect to risk classification, so there are no prohibitions against using factors such as age and sex and race as well. However, insurers don't, at least I'm not aware of any situations where they have gone that far to use race as a condition. I know that there are some potential allegations that that's being done because there are some neighborhoods, at least outside of the Toronto area, where there are a lot of claims coming in. And so they're looking at it not from an underwriting perspective, but more from a claims perspective, saying, why are we getting so many claims from this township outside of Ontario? And it just so happens to be a township with a lot of Southeast Asia residents. So there have been some rumblings in the news about how to deal with that. But no, there is no restriction about race in the
I would probably reach the same conclusion that you did, that there are no or very, very few companies that say, oh, here's our rate for Black people, here's our rate for people of Asian descent, here's our rate for Caucasians or white people. I think that they might not put that in their rate filing unless maybe the Sackler family decides to leave pharmaceutical and get into insurance, in which case they might have some internal memos that would say that and they wouldn't necessarily put it into their rates. But what we're talking about here is proxy discrimination. And my question really goes to your presentation on the categories that were included. Were they included, number one, for because they were not actuarially sound or had an actuarial value, or were they included because even though they had an actuarial value or could be perceived to have an actuarial value, public policy mitigated against it? Is it the latter situation? Because my sense is that it is.
Yeah, I mean, so the overall piece of legislation is, again, the Human Rights Code, right, of Ontario. So much of these acts, even though they're not excluded from the auto legislation, most of these grounds would be discriminatory anyway, right? And so the issue in the Supreme Court of Canada case was the court finding that there were no practical alternatives, but also it fit within this reasonably bona fide exception, right? So the criteria that the auto insurance legislation is specifically targeting, to me, it looks a lot like its level of income, employment history, occupation, and credit rating, which actually credit rating was dominating the news recently because the allegation was that if people have a poor credit history, then they're more likely to default either on premiums, but also be more high risk drivers. So I'm not sure if that answers your question, other than to say that there seems to be a lot of moving targets here in terms of what sort of where this is all going, I guess, for lack of a better way of saying it.
I guess one last question for you, and then I have one more question, Mr. Chairman, for one of the other panelists. One last question for you is, does the Canadian law or the Ontario law specify intentionality, or is it just a blanket prohibition against discrimination using those factors?
So there is a subjective component. So in the Zurich case, they held that the insurer was being discriminatory, but it was done in good faith. It's not like they weren't being discriminatory for any malice or anything like that. It was intentionally discriminatory, but there was a good faith element to it. If there was evidence that the insurer was doing it because of a systemic racism or whatever the case is, then they wouldn't get to use the exception like that. The objective component, again, in the Supreme Court case was based on the use of practical alternatives and all that. So intention plays into it, but it's not so much if it's intentional or not. It has more to do with why you were doing it.
Thank you. And I would like then, Mr. Chairman, just to go back to our first panelist, and forgive me for not remembering his name.
That would be Mr. David Eccles.
Thank you. I think it's Professor Eccles or Mr. Eccles. Just in your demonstration about the difference between the two, disparate treatment and proxy discrimination, you made the point that was widely discussed in our last meeting about the question of intentionality, leaving out willful or negligent or known non-willfulness. That is, things that might be known or things that might be perceived or things that might be of great risk that some have opined would also equate to proxy discrimination. Do you believe that there is a need for a demonstration, an affirmative demonstration of intentionality before a determination of proxy discrimination is obtained?
I think if you're thinking about proxy discrimination, as I think about it, it's something that is in an insurance context, say a factor is being used to discriminate. I think there is intentionality. So it would be that instead of just explicitly having a race, you use zip code to use the other panelist factor as sort of an intentional way to get around that race not being allowed and using that as a sort of proxy for race. So I think in my mind, yes, there would have to be intentionality.
So in your view, it requires intentionality. Thank you, sir. Thank you, Mr. Chairman. I might come back with more questions. Hopefully not for this panel, but maybe for the next.
Hearing no additional questions, and it now being 3:38, let's adjourn until 3:50. For everybody back at 10:04. Okay, beginning the second part. Lead off with Jim Lynch, Chief Actuary and Senior Vice President of Research and Education at the Insurance Information Institute. Mr. Lynch.
Thank you very much. Thank you very much. I first would like to thank Senator Breslin, CEO Considine. Let me see if I can get my presentation up here. I think I want this. Okay. Again, I'd like to thank you, Senator Breslin, CEO Considine, and the staff at the National Council of Insurance Legislators for giving me the opportunity to speak on this important topic.
Make this.
Can you hear me okay? Okay. My name is James Lynch. I'm Chief Actuary, as he said, and Senior Vice President of Research and Education at the Insurance Information Institute. We provide objective, fact-based information about insurance, information that is rooted in economic and actuarial soundness. I am a fellow of the Casualty Actuarial Society, the leading property casualty actuarial organization in the world, and I've served on its board of directors. I have more than a quarter century of experience in property casualty insurance and reinsurance, and I have held senior actuarial positions at QBE the Americas and White Mountains Reinsurance of America. The III commends the efforts at NCOIL to try to understand and address today's topic. Like NCOIL, the entire property casualty insurance industry, companies, academic researchers, regulators, trade associations have been focusing on this important issue. It seems clear that all parties sincerely want a more equitable society. And working cooperatively, we can find solutions that address the issue of systemic racism while preserving the competitive environment that allows the insurance industry to keep its promises and protect its customers. At the same time, it is important that the discussion be based on thorough, fact-based research. There are quite a few of these going on, and I'll discuss that a little bit later. NCOIL has been asked today to comment specifically on research conducted under the auspices of Consumer Reports magazine and ProPublica. Consumer Reports has a well-deserved reputation for rigorous independent product testing, and unfortunately in this particular case, its research fell short. And I'm referring to the study that was discussed earlier today by ProPublica. And that study, which was conducted in 2017, attempted to be rigorous. It purported to find, quote, substantial disparities in auto insurance prices between majority white and majority non-white neighborhoods. These disparities, it concluded, were larger than risk levels could explain. The study, unfortunately, made elemental errors that, once corrected, showed the exact opposite of what ProPublica asserted. Auto insurers charge prices that properly reflect the actual risk in majority white and majority non-white neighborhoods. Now, there are certain things it's important to know about rating variables. First, they work. They are effective at gauging the likelihood that a customer will be in an accident. Second, every rating variable has been proved effective through actuarial analysis of actual data. Third, they are filed in advance with state regulators along with statistical proof of their effectiveness, and they cannot be changed without similar statistical analysis. Fourth, companies constantly review how effective these factors are. If they don't work in the real world, they are adjusted or abandoned. Last but not least, the setting of private passenger auto insurance rates is a colorblind process. Insurers do not gather information based on race or income, nor do they discriminate against anyone on the basis of race or income. The ProPublica study alleges that auto insurers systematically price gouged minority communities and areas with predominantly low-income households. In their words, quote, some major insurers charge minority neighborhoods as much as 30% more than other areas with similar accident costs, unquote. That charge is simply inaccurate. Researchers, regulators, and policymakers took the allegations seriously, examined them from different perspectives, and in each case concluded that ProPublica got the analysis entirely wrong. ProPublica looked at zip code level auto insurance losses in 4 states where that information is publicly available. Their researchers fit a complicated mathematical model to those losses and compared the model's predictions of losses to the premium that a hypothetical driver would pay in those zip codes. And they found, quote, that many of the disparities in auto insurance prices between minority and white neighborhoods are wider than differences in risk can explain, unquote. NCOIL, like many insurance organizations, were concerned about the charges. If it was true, it would paint a damning portrait of the entire property casualty industry. So at NCOIL, we hired a highly respected actuarial firm, Pinnacle Actuarial Solutions. Their overview of the ProPublica study found, quote, multiple concerns with the analysis and resulting conclusions, unquote. The most prominent, ProPublica didn't properly handle zip codes in which there wasn't a lot of data. The branch of mathematics that deals with thin data in insurance is called credibility, and it is part of the standard actuarial curriculum. As far as we can tell, ProPublica did not make any accommodation for this standard actuarial adjustment. Now, it's actually not too hard to determine whether pricing models charge exorbitant amounts in minority neighborhoods. You just need to look at the losses incurred and the premiums earned in those neighborhoods and compare them with the losses and the premiums earned elsewhere. The metric to do this, and I think many of you will recognize it, is the loss ratio, which is losses divided by premiums. If ProPublica were correct, minority neighborhoods would have loss ratios substantially lower than other neighborhoods. People buying insurance there would receive less back in loss payments per dollar spent than would those in other areas. So lower loss ratios in minority neighborhoods would be evidence of unfair discrimination. So now let's see what that simple, powerful analysis shows. Here, an insurance trade group used the same loss data ProPublica got and the actual premium data that corresponded with those losses. And that it got that from state regulators. And this shows Chicago and the rest of Illinois separately because ProPublica focused on the state this way. And the two areas are quite different in both demographics and in traffic patterns. In both cases, the loss ratios are quite close. On the left, minority neighborhoods posted a loss ratio of 55%, meaning that for every dollar of premium policyholders paid, 55 cents was used to cover claims. That's slightly more than happened in other neighborhoods where 53.8 cents of every premium dollar was used to pay claims. So in Chicago, people in minority neighborhoods actually got a slightly better deal since they received slightly more of their premium back to handle claims. Remember, lower loss ratio in a minority neighborhood would be a sign of unfair discrimination. But here we see the opposite, although the difference is pretty small and it's likely due to chance. And in the rest of Illinois, the situation is similar. Minority neighborhoods post a loss ratio of 57.2%, just a little bit less than other neighborhoods, again, likely due to chance. These results are close. There is nothing approaching the level of overcharging that ProPublica's analysis implies. In fact, there is no evidence of overcharging. Slide 3, this next slide, shows results in 2 other states where ProPublica found discrepancies. And again, you can see when you look at real data, there is no evidence suggesting any accusations of rate disparity that ProPublica alleged. ProPublica got the analysis entirely wrong. The state of Missouri did its own more comprehensive analysis and concluded that, quote, no evidence was found that would indicate that higher rated territories are charged more relative to risk than lower rated territories. And then they added in a footnote, quote, ProPublica got the analysis entirely wrong. Now, you might remember a few months ago, I was talking about some actuarial stuff, and I pointed out the biggest mistake that ProPublica made was apparently they failed to make standard actuarial adjustments to the data. Now, what would happen if you used ProPublica's methods, but adjusted them appropriately? California regulators actually did this. They used ProPublica's modeling to look for discrimination in individual rate filings, but they made the appropriate actuarial adjustments. Now, California classifies neighborhoods as underserved and non-underserved, but those terms closely align with minority neighborhoods versus other neighborhoods. And the next slide shows you the result of that. These are 2 examples from actual filings for actual insurance companies. And you'll see that in the first, I took out the name of the company in both cases, but in the first, while the underserved neighborhoods are charged 25% more than the non-underserved, they also experience losses 40% more than the non-underserved. And in the other example, while the underserved are charged 25% more than the non-underserved, the underserved experience losses 27% more than the non-underserved. In both cases, using actual data from actual filings, the Department of Insurance found that the areas in question paid considerably more for insurance, but they also had considerably more expensive claim costs. This was consistent with the loss ratio analysis in Illinois, Missouri, and Texas that we just looked at. It was consistent with what Missouri regulators found. The groups that pay higher insurance bills are higher risks to the insurance company. That's the way insurance is supposed to be. And it's another way of saying that ProPublica got the analysis entirely wrong. So now the growing awareness of historical injustices make these unprecedented times. And we're living it in 2 or 3 dimensions, even on this very day. And as the insurance industry, along with the rest of America's business and governmental institutions, examines past injustices and looks for appropriate remedies, it makes sense to incorporate high quality, relevant research. Committees of both the Casualty Actuarial Society and the American Academy of Actuaries are examining the matter. The NAIC is conducting research. The Insurance Research Council, which recently began a closer relationship with III, is looking into the impact of insurance credit scores and race. And I think we all welcome to such sober efforts in our united quest to create a more just society. At III, we would strongly recommend any insurance policymakers or regulators look to research from organizations that have a credible, long-term commitment to understanding and improving the insurance industry. We would recommend you avoid overemphasizing the work of those who, though well-meaning, lack the grounding in property casualty actuarial techniques and therefore can reach incorrect conclusions that could have far-reaching detrimental impacts. Thank you again for allowing me the opportunity to speak today, and I welcome any questions that you might have.
Thank you very much, Mr. Lynch. Any questions? No, we'll take questions after all the groups speak. Tom Carroll is next up, General Counsel of Federal from the National Association of Mutual Insurance Companies. Name it.
Thank you, Senator. I appreciate your being here today. I've asked the NCOIL staff to help me with the slides, so when they'll bring those up. I did have to say, Senator Breslin, that when you mentioned that it was going to snow tomorrow, as someone who grew up in upstate New York, I'm not the least bit surprised that there's some snow in April.
That doesn't make me feel any better at all.
I am the General Counsel Federal for the National Association of Mutual Insurance Companies, which is the largest trade association for property casualty insurance. And thank you for having me here today. I've been asked to speak today about the standards for disparate impact that have been set up, particularly by the United States Supreme Court, and how they may impact state laws. In my role today, I'm going to attempt to be an educator and not an advocate, but I also, in fairness, must disclose that I've been NAMIC's lead lawyer in challenging some federal government disparate impact rules for several years. Next slide, please. The lead case that I'd like to talk about today is in Texas Department of Housing and Community Affairs versus Inclusive Communities, which is 2015 case. There were earlier cases and several Supreme Court challenges regarding disparate impact, but inclusive communities, as we'll refer to it, most people do, was one of the one case that finally made it to the Supreme Court to deal with some of the real clear issues. I must make clear that the inclusive communities did not involve insurance directly, but did provide specific legal standards by which to perform the legal analysis of disparate impact. And it would be prudent for state legislators and state regulators to understand and appreciate these Supreme Court analysis and reasoning prior to adopting any disparate impact state legislation or regulations. Next slide, please. It's important to realize there was some discussion earlier about disparate impact and disparate treatment, excuse me. Both have legal definitions for illegal discriminatory practice. In contrast to a disparate treatment case where the plaintiff has to establish that there was a discriminatory intent or motive, the memo that was referred to earlier as well, the writing things down. In a plaintiff bringing a disparate impact claim challenges that have it must show that there's a disproportionately adverse effect on minorities and are not otherwise just unjustified by a rational basis. So Disparate impact does not require intent at all. And disparate impact, there's other terms that have been used: differential impact, disproportional impact, and some other terms that are bandied about, but these are not legal definitions and they're not actionable. So the important thing to do is focus on disparate impact, which does not require intent, and disparate treatment that does. And the court in inclusive communities recognized that there was disparate impact that would not subject the practitioner to liability. The court basically said that, frankly said that disparate impact liability must be limited so that other employers and other regulated entities are able to make practical business decisions choices. It recognized, it did not go so far to say that there was specifically good disparate impact, but it did recognize permissible disparate impact. Next slide, please. The court recognized that there were proper limitations to disparate impact liability. They said this several times, and they said that it's properly limited to avoid serious constitutional questions. It cannot be based solely on the showing of statistical disparity. If the population of a protected class is X, the fact that the impact has been different than that number does not necessarily by itself show disparate impact. And the court actually warned that without adequate safeguards, disparate impact might actually lead to cause race and other protected classes to be considered in a pervasive way and lead to numerical quotas and serious constitutional questions. So it's not just the numbers. The numbers are a starting point, and it's important to realize that, but there are great warnings that numbers alone don't get you to the point of liability. Next slide, please. The court articulated cautionary standards concerning disparate impact, and these were specifically to the Fair Housing Act and Title VII, and presumably other laws, that would mandate only the removal of artificial, arbitrary, and unnecessary barriers, and not the displacement of valid policies. So that basically, in order to prevail with a disparate impact case, you have to show that the practice, and I'll just describe that a little bit later, is artificial, that is made up, arbitrary, has no basis, and totally unnecessary. Fairly high standards to show there that basically variations from a numerical equilibrium is not in itself a violation. There has to be some disparate impact that is caused by a policy that is not at all rational, is not at all necessary. The showing of a racial imbalance would not without more establish a prima facie case of disparate impact. The plaintiff must prove a robust causal relationship between a practice, not just one action, but an existing practice, and any statistical disparities. So it's a causal connection. You have to tie the action that's being alleged to be causing the disparate impact to the disparity, and then show that it's not just a one-time action, but in fact a practice. Next slide, please. Even if these elements are shown, a defendant can still prevail by showing that the challenge policy, again, it's a policy, not an action, is necessary to achieve a valid interest. It's kind of the accidental discrimination, if you will, that a business or a government entity is doing this. It did not mean to cause this disparity in terms of statistical variations, but basically it's doing it for a good reason. Now, once they establish that, all the above is a finding of disparate impact. If the court or applying these standards determines that it's improper disparate impact, the next step, which is very complex, is the remedy. How do you change that policy? You can find the liability, but to get rid of the underlying discrimination, following the finding that there is disparate impact, you have to basically say that there has to be a less discriminatory alternative phase. Now, basically, either the court or the plaintiff has to come up with that and say, rather than do what this company or this government entity is doing, they have to do it a different way and indicate how this burden would be less. So basically, they've got to come up with a replacement, less discriminatory policy that could provide the necessary business or governmental function and still have a less disparate impact. Very, very difficult to do, very difficult to show, particularly on the plaintiff side, where they may not fully understand the purpose and the policy and the operations of the existing policy that's being challenged. It's a very brief overview of the requirements that would be required by the Supreme Court. Inclusive communities, as I said, does not explicitly require any state insurance disparate impact law to comply with every provision stated. However, it's a virtual certainty that if a state insurance disparate impact law is enacted and it does not comply with inclusive communities, it will be subject to litigation challenges and will be challenged in courts. So that states that ignore inclusive communities in enacting disparate impact laws will do so at their own peril. I'd be happy to answer any questions you have or at the conclusion of these testimonies.
Thank you. No questions? Thank you very much, Tom. There'll be questions after the next speaker. We'll get it at the end, Kevin. Next speaker will be Melinda Bender, who's co-chair of the Casualty Actuarial Society, the Society of Actuaries, the Joint Committee on Inclusion, Equity, and Diversity. Ms. Bender.
Thank you, and thank you for having me today. So my name is Malika Bender. I'm a PNC actuary, and I'm a fellow of the Casualty Actuarial Society. And I also lead diversity, equity, and inclusion initiatives at the CAS. I was asked to come here today to give a brief overview of our Casualty Actuarial Society approach to race and insurance pricing. And our goal in the CAS is really to equip actuaries to be able to proactively address some of the issues around race as it relates in particular to insurance pricing we're all talking about today. To that end, we've laid out activities in 4 different areas, including leadership, collaboration, education, and research. And these areas are all intertwined to the extent that one allows us to do the other. And I was just going to talk a little bit more about some of the areas of research that we are pursuing. So Jim, mentioned the CAS and the Academy of Actuaries as a few different actuarial bodies that are looking into these things. I don't have any slides, so I'm just going to speak very briefly. The efforts that we're looking at in terms of research, I would put into 2 general categories. One being foundational knowledge to equip actuaries for discussions like today's around systemic racism. So really understanding, defining these different terms like bias, fair and unfair discrimination, and disparate impact and their implications on insurance, which as you've all kind of seen, there's many different interpretations and ways to use these terms in the general public. So we want actuaries to have a good understanding of the technical terminology here. Looking at the actual historical influence of systemic bias and racism on the underlying insurance data. So how we end up with unbalanced distributions in credit score by race or highly segregated zip codes, allowing actuaries to understand what's caused those underlying distributions to be unbalanced will help us to understand and develop solutions potentially. We're also looking into actions taken by other industries, including banking and financial services, to address the presence or disparate impact or other systemic racism issues. And we're looking at analysis of outcomes from actual historical regulation and legislation around the use of specific rating factors in other jurisdictions. So if, for example, a state or province has limited the use of credit or gender, like was mentioned earlier in the EU, we'd like to understand what the market outcomes are of those to better understand what might happen in the future. So that brings me to some more of the forward-looking research that we have planned. One of those is stress testing rating models for the outcomes of if different rating factors were limited or prohibited under legislation or regulation, what changes in positive and negative ways. We also may expect that if, for example, a rating factor is removed from a rating plan, that other rating factors might pick up some of that signal, right? So it's not going to be cut and dry, positive or negative influence. There may be some gray area there. So we're looking at that. We'd also like to proactively develop actuarial methods for measuring and quantifying disparate impact, with the next step being to understand what potential solutions are out there or could be developed to address this concern. And then, as was mentioned earlier, there is quite a bit of new technology being used in actuarial practice and in insurance in general, like artificial intelligence, telematics, usage-based insurance. And we are endeavoring to research what are the positive, negative, or neutral impacts on discrimination or disparate impact in rating that could arise from the uses of those new technologies or the shift towards those new technologies. So we are looking for collaborators for a lot of these projects because, as I think one of the themes that came up in today's conversation is, the use of data and the availability of data to do these analyses is so important, getting the right data and being able to apply actuarial techniques to that. So we're pursuing some of these now and looking for collaborators and different sources of data to pursue some of the forward-looking research in the coming months and years. But we are looking forward to having more to report and to share as we develop some of this information further. I should also say that the Casualty Actuarial Society is not a public policy organization, so we're not producing this to necessarily influence any policy, more to equip our members and educate our members around these issues so that they can be active participants in the work that's ongoing in the industry. So that's all I had, but thank you again for having me today.
Thank you, Malika. The next speaker will be Andy Kramer from the ACLI. Mr. Kramer.
Thank you, Mr. Chairman. I'm sharing my screen and we'll start the slideshow. All right, and what I will be speaking on today is just basic overview of the life insurance industry and the evolution of the industry that has accelerated in the last year because of the pandemic. So the objective here is to discuss the different types of insurance for life underwriting and the trends that we can expect. When I say life underwriting, I'm referring to not only life insurance, but also disability income and long-term care insurance. They're generally all lumped in the same bucket of life insurance underwriting. So the agenda today, we'll talk about the differences between life insurance and property and casualty. A lot of people get your typical consumer dumps all insurance into the same bucket and they don't differentiate, but there's some significant differences between life and P&C that I just want to point out. Some are pretty obvious, but they have a big impact on the life insurance underwriting process. And then we'll talk about the different types of life insurance underwriting. There's guaranteed issue, simplified issue, there's traditional or sometimes called full underwriting, and then the late entrance to the game is the accelerated underwriting, which has made great strides in the last year because of the pandemic. I'll do a quick comparison of the inputs for traditional and for accelerated underwriting, and then I'll talk about some industry trends and what we can expect out on the horizon. So for the differences between property and casualty and life insurance underwriting, on the property and casualty side, generally the coverage is required, whether it be auto liability required to license your vehicle or homeowners as a condition of the loan agreement. And because of that, you have a much lower risk of adverse selection. Now, when I use the term adverse selection, for those that aren't aware, I'm talking about when an insurance company extends insurance coverage to an applicant whose actual risk is far greater than they had expected based on the information they had. Or put another way, people of a higher risk generally want to purchase more coverage and because they can get it at a cost below what they feel is equitable. On the life insurance side, the coverage is optional, and that's where you get that potential for increase in adverse selection. On On the property and casualty side, you can reprice the risk on a periodic basis, whether it be every 6 months or every 12 months, depending upon the policy period. In life insurance, it's only underwritten once, and there's no change to that rate or that price to match the changing risk profile. So if you underwrite somebody today and they then develop a heart condition or cancer or something, you can't change your price. You've got to live with the price that you extended. It's a unilateral contract. On the property and casualty side, the loss amount is unknown, but the loss event horizon is fixed. It's that 12-month policy period. On the life insurance side, the loss amount is certain. It's fixed at the face amount, but the event horizon is unknown. So you've got the future years and the interest rate changes and all the other environmental changes that can occur between now and when that eventual event occurs. In the P&C world, the profitability can be determined pretty quickly. At the end of the year, you add up your premiums, you subtract your losses, your expenses, and your incurred but not reported claims, and you've got a pretty good estimate of your profits or losses. In the life insurance world, you've got to estimate all of the future premiums and take the present value of that. You've got to estimate all the future losses and take the present value of that. So a lot of moving parts. It's much more difficult. It takes years to determine the profitability of a book of business to make sure just to understand, did you make the right underwriting decision on that book or not? So, obviously in the life insurance world, there's a lot of hesitancy and reluctance to move forward and drive change. It's probably one of the least changing industries in the marketplace. And finally, investment return is a key driver of profitability because of the long-term nature of the business and that long-term pricing horizon. A key component in the pricing calculation is the interest rates that you're assuming on your investment portfolio that you've taken out to cover all those future losses. Again, as I mentioned, underwriting is at the time of the application is critical. Underwriting is that process of classifying all of the risks by the risk of that person either dying prematurely, becoming disabled, or needing long-term care. By law, we must be able to demonstrate that the similar risks are treated in a similar way, and it's actuarially sound and they reasonably anticipate experience. The goal is to have similar risks priced with similar premiums. And the key benefit of full underwriting is that it enables insurers to make products widely available and affordable at the lowest possible cost. If it wasn't for underwriting, you wouldn't be able to have people protect 10 or 20 years of future income for their income protection coverage. And I'll give you some examples. This is an important point that I can demonstrate when I talk about the different types of underwriting. So in the final expense market, sometimes known as burial insurance, you've got two different types of coverage. You've got your guaranteed coverage, and that's basically you take all comers. If they sign the application, you insure them. The only way that the insurance carrier protects their bottom line and the risk for their mortality is they exclude claims that occur in the first 2 years. Generally, it's a 2-year exclusion, where if you die in the first 2 years, it's a refund of premium plus interest. These are generally very small face amounts, $1,000 to $50,000. Generally, it's a lot of times they're sold to cover funeral costs. You might see these sold on TV ads. You cannot be turned down. You might see these in mail flyers, in direct mail campaigns, and generally these cost about 2 times. I did some ballpark estimates based on my own profile, shopping different online sources for this coverage. And generally I found it was about 2 times more expensive than simplified issue. And that's because they don't underwrite. They have to take all comers that apply. On the simplified issue side, it's generally accept and reject. It's a little bit larger face amounts, 5,000 to 200,000. Smaller number of health questions, generally 2 to 7 health questions. Identifying and weeding out the leading causes of death, a cancer question, a cardiac question, et cetera. They may perform a prescription drug check just to try to sniff out any adverse selection or non-disclosure on the application. And the product is priced with a sizable mortality load because that very simplified underwriting can't weed out all the risk, but it weeds out quite a bit. Generally, these cost about 3 times more than a full underwriting best class, and about 2 times or 1.5 times more than your full underwriting standard class. So these serve a very important niche in the marketplace. These two product types generally serve the underinsured population, where they just need coverage to cover the final expenses, so they're not a burden to their loved ones when they finally pass on. Finally, we get to the traditional underwriting or the full underwriting, and I'm also going to pivot over into accelerated underwriting. Your full underwriting uses your traditional underwriting data sources, and it's a very lengthy process. Generally, when you get above a certain age or a certain face amount, like $500,000 or $1 million, it requires a paramedical exam and laboratory results. They do a blood profile and urinalysis. And when needed, they'll access your medical records. You generally go to your physician and get a copy of your medical records. They generally underwrite to multiple preferred classes, multiple standard classes, and then maybe 10 substandard classes. So it gives you a broad spectrum so you can maximize the number of applicants that you can insure, but you charge them the best rate for their particular risk attributes. Generally, full underwriting can take 30 to 60 days. In the COVID-19 world, it has taken longer because it's been harder to get medical records and medical exams, primarily medical records, because doctors' offices have had all hands on deck in their clinics to serve patients, and they didn't have excess people that could photocopy the records. But that brings us over to accelerated underwriting. What accelerated underwriting evolved 5 to 6 years ago. It started to get mainstream, where carriers were using alternative data sources and predictive models to identify those, quote, clean cases, those low-risk cases, and accelerate them through the process, waiving paramedic exams, waiving laboratory results, and not requiring medical records. This reduced the underwriting process from weeks to days. And it was a huge advantage during COVID-19 when the applicants were reluctant to have a paramedical examiner coming into their home. That examiner may have been in 2 or 3 other homes that day, and they didn't want to take a chance of catching COVID-19, or they couldn't get the medical records. The accelerated programs, from some of the data that I've seen, they had a four-time increase in volume from March through June of last year, and now they've really taken hold, and virtually every carrier put resources into developing or improving their accelerated underwriting programs, and I think this is going to be the wave of the future. The sources for accelerated programs include electronic sources that you can generally get in either real time or very short period of time, as opposed to medical records that take weeks. You can do a prescription drug check pretty quickly, generally within a minute or two. You can get electronic health records. This is a benefit from the Affordable Care Act, where they digitized all the medical records, and these now are available pretty quickly, and they're very, very accurate. It's been a huge time saver and allowing applicants and customers to get their policies issued very quickly. There are medical claims data sources and clinical laboratory tests that we can access very quickly. So the industry trends, as I see them going forward, the pandemic has accelerated the change adoption in our industry. Like I mentioned, life insurance has historically been known as one of the slowest moving industries because you have to be very cautious if you can't see your profits emerge for 5 years. But the pandemic accelerated that change. It got the producers accustomed to the change and willing to make the change. It forced the home offices to drive change, to find new ways and force new ways of doing business. So it was truly a benefit to the industry. The accelerated programs enabled companies, like I mentioned, to issue policies when they otherwise wouldn't have been, because the customers were leery of the medical examiners. And then, like I said, the carriers have invested heavily and are continuing to invest in these programs. And I think we're going to see these accelerated programs continue to advance very quickly. We're seeing changes announced almost monthly now. And it's dramatically improving customer experience. Like I mentioned, cases are getting placed faster. They can get the coverage they need while they still remember they've applied. And then in carriers now with the pandemic, they're being really challenged by the low interest rate environment, since a lot of their investment portfolios are invested in those long horizon assets, long duration fixed income and stuff like that. And the interest rates are very, very low. Every carrier is looking for ways to cut costs so they can maintain the crediting interest rates for their policies, to keep their policies attractive to consumers. These accelerated programs are enabling them to underwrite through low-cost channels. So it's been a big win for the carriers. Expect additional evolution in this area with the digital move like this, moving away from paper, moving toward digital fulfillment, digital policies, digital signatures and stuff like that. This may require some regulatory changes in some areas. Some of our regulations are 20 and 30 years old and are predicated on a paper application, a paper policy, and a wet signature. So we probably need to look at that. And then the final trend that I want to point out here is historic life insurance underwriting has been focusing on the effect on your organs from your lifestyle. Looking at the evidence of the end organ damage from the decisions you've made over the prior 20 years. But what we're realizing is these lifestyle choices, which take years to affect us, can be identified very early, particularly with wearables, with our cell phones, with all the wellness applications that we use. We track diet, we track exercise, sleep, stress, etc. I think what we're going to see is a trend where carriers offer the applicants an option of sharing that information for potentially higher price discounts right up front. So that's the one that gets me the most excited, because I think that's truly going to make insurance even more affordable to the people that really do take care of themselves and are very concerned about a healthy lifestyle. So that's all that I had for my presentation. Be glad to take any questions or hand it back to you, Mr. Chairman. It looks like your mute might be on.
Thank you very much. There'll be questions after the final speaker, who is Rick Swedloff, the Vice Dean and Professor of Law and Co-Director of the Rutgers Center for Risk and Responsibility. Rutgers Law.
Thank you, Mr. Chairman, and thank you, Tom, for inviting me to speak today. I'm particularly sad not to be there. I grew up in Charleston, in the Charleston area, and the meeting is taking place literally 3 to 4 blocks from my mother's house. She's particularly sad that I'm not there today. So, I am jealous of all of you. I hope you all enjoy what is an absolutely beautiful time of year in Charleston. I want to start by saying that I very much admire the work that everyone is doing here, or that the committee is doing here. It is certainly the case that by defining that by defining proxy discrimination will be helpful, especially because I understand that legislatures are starting to use that term without definition. So that's very useful. And I think to the extent that one of the things you're trying to do is identify obvious proxies, that will certainly help, at least in the short run, prevent the kinds of invidious discrimination that insurance regulators have long sought to eliminate. Let me sort of give my sort of 2 basic concerns. My first concern is about the definition itself. Sorry, well, let me start it this way. The definition says that it is that proxy discrimination is intentional substitution of a neutral factor for a set of prohibited other factors: race, color, creed, national origin, or sexual orientation. That is, it is not permissible by the statute to intentionally substitute this neutral factor for one of those prohibited categories. I think this is, as I said, a laudable goal, and it may make sense to stamp out that kind of invidious discrimination, intentional discrimination, but I have some fear that the definition is too focused on intent, as others have said, and I have another fear, and maybe this is why I've been asked to speak last, that the definition is wed to a traditional method of underwriting that may be sort of heading into the sunset, although others here are more qualified to say how long that time horizon will be. So let me start, as some law professors like to do, with a hypothetical, with, or maybe it's better thought of as a story. And we'll talk about what I think traditional underwriters have done over time. When traditional underwriters are thinking about how to determine what price to give a particular category of or group, they have to select a factor or a group of factors that they believe will correlate with loss. For example, an insurer might ask, does the age of a house correlate at all with the likelihood that the house will burn down or that the house will suffer greater losses if there's a fire? The insurer can then run some fairly standard, the underwriter, the insurer, the actuary, can run some fairly simple regressions. That is, they use some fairly simple statistical techniques, not to denigrate the work that the actuaries are doing. I understand it's beyond my ken, but I just mean to separate it from what's going on, sort of more complicated computer modeling. And they determine whether it's true that the age of housing is related either to loss or to higher losses in the case of a fire. If it's true, then those with older houses may be asked to pay more for insurance than those who are similarly situated but live in newer homes. Now, imagine that insurers don't have access to information about the age of housing stock, or for some reason, the state legislatures have prohibited them from using age of housing stock in their pricing. In that case, insurers might look to obvious proxies for the age of a house. For example, they might use zip codes or census tract data or something along those lines, which one might imagine could correlate with the age of housing stock. So this hypothetical raises the first concern I have with the new definition. The same data that might be useful for identifying the age of the housing stock could also be highly correlated with a prohibited category, right? It's not hard to imagine, and in fact, Julia suggested earlier, that zip code data, which could be useful for figuring out the age of housing stock, could also be useful for figuring out the racial characteristics or the racial makeup of some areas, right? So if companies are facially using zip code data as a proxy for the age of housing stock, can they avoid rate regulation under this sort of proposed statute because they are not using zip codes, quote, to intentionally substitute for race? So this is the difference between prohibiting intentional discrimination and disparate impact. The statute seems solely focused on the former, although it's using some confusing language, I think, and I appreciate what others have done to try to make that difference clear. I won't belabor this point, as others have sort of made some discussions about what is and isn't the value of disparate impact at this moment. I'll talk a little bit more about that in a moment. And I assume that this concern has been more fully vetted at earlier meetings, but it's something for the committee to keep its eye on, because it may be that simply identifying obvious proxies that have been discussed today by Peter Kotchenberger and Julia Angwin is less useful, because the definition that's provided in the statute specifically says that companies cannot use those obvious proxies as a substitute for a prohibited category, but implies that they could use those obvious proxies for other purposes, right? Okay, so that's sort of my first set of concerns. My larger concern, however, has to do with how this legislation will work in the long run. Insurers are increasingly incorporating artificial intelligence and machine learning into their underwriting processes. AI, in short, right? And again, I hope I'm not repeating things that everyone knows, but for those that don't, I'll be very brief. AI, in short, don't be afraid. It's not like the movies. It's not some sort of machine out to kill us. It's just a set of techniques employed by computer scientists to help computers solve problems. The most commonly used technique in AI is something called machine learning. Machine learning is quite simply is quite simply an automation of sophisticated statistical techniques. Other AI techniques are less based on traditional statistics, but are instead based on sort of complicated matching or pattern recognition. Regardless of the particular technique that's used, the computers use algorithms to sort through data in an iterative and unsupervised fashion, right? And what that means is what they're trying to do is sort through this data to find a particular output. Let me sort of say it more colloquially and say it in the context of the kinds of risk classification we've been talking about today. In that context, an algorithm could search through training data. For example, it could search through the data of all the losses of a particular homeowner's insurer, to find which bundle of characteristics best correlate with loss. That process is, as I said earlier, unsupervised and unstructured. And what that means is, in contrast to traditional statistical techniques, where a human has to have some intuition about a set of characteristics that might correlate with loss, the algorithm, the AI, has no such prior judgments and is simply trying to find the best set of characteristics that match with that loss, right? It is simply sifting through the data iteratively, time over time over time, until it can best match a particular set of characteristics to loss. That set of characteristics can be radically larger than any traditional underwriting set of characteristics. So traditional regression analyses are limited to 10, 15, 20 characteristics. AI are not so limited. They could have hundreds and hundreds of characteristics. To be sure, machine scientists, data scientists can insist that algorithms don't use particular characteristics, race, creed, color, national origin, sexual orientation, if that's what the legislature says they can't use. And of course, the data scientists could also prohibit the algorithm from using obvious proxies for those characteristics. So if you all say, you know, probably shouldn't use zip code, or probably shouldn't use credit score, probably shouldn't use criminal history, all totally viable things that the data scientists could go in, program the algorithm, and it would not use those but because AI can use many, many more factors in its underwriting than traditional statistical underwriting, there are new risks that aren't being addressed by the current statute. Specifically, the one I want to talk about here is the risk that AI could come up with a bundle of characteristics that taken together look are not an obvious proxy, but taken together nearly perfectly correlate with a prohibited characteristic, right? So it's not the kind of obvious proxy discrimination that you all are worried about in this statute that represent the kind of intentional discrimination prevented by this new definition, but rather will nonetheless burden the groups that the state statutes have sought to protect from higher prices. What to do about that problem is a really complicated question. And as Mr. Carroll added, it is difficult in part because whether we care about those things might in part depend on the line of insurance and the rationale for the burden on those groups. So for instance, no one is probably particularly concerned that the elderly are going to pay more for life insurance, even if we wanted to protect the elderly, for instance, from having to pay more for homeowners insurance, right? Those are questions that are deep and difficult to answer. But it is the case that I think we're going to have to stop focusing solely on intentional discrimination and move more towards thinking about disparate impact, right? So to do that, we need to do several things. The first is collect more data. So Julia mentioned this, and as did Malika, Malika, I apologize if I've mispronounced that, but we need to have more data that's more available to more people so that independent third parties can be doing analyses of what the kinds of burdens that are befalling certain groups. Insurers can't be prohibited from collecting this information, right? So they might need to be some of the restraints on insurers that sort of prevent them from asking questions about race, creed, national origin, et cetera, might need to be loosened so that we get more of that data. But then in exchange, what we need is more sunlight about what kinds of losses different folks are suffering. Once we have that information, we can then have these deep conversations about when we care about the fact that people of color might be paying more. And I take the earlier commenters from III statement at face value that he doesn't believe that they are, but let's assume that they might be in some situations. If they're paying more for certain lines of insurance, why? Do we care? Is it problematic or not? We could certainly tune algorithms once we have this data to prevent some of this, or we could structure our regulations in a different way so that we limit the spread of different rates. Lastly, I just want to sort of clarify one thing that Mr. Carroll said. It is, of course, true, as he points out, the disparate impact under the Supreme Court's analysis of particular statutes and particular constitutional provisions has been limited in a number of ways. It's been limited so that there are lots of defenses for disparate impact, and it's very difficult for plaintiffs to prove disparate impact. I'm not so convinced, however, that states couldn't do more under their own statutes and in their own constitutions to prevent disparate impact for insurance if they so chose, right? So this is a situation where federalism has to come to the fore. How that interacts with Supreme Court doctrine on disparate impact is a very complicated question and one that has not yet really been answered. So in short, what I want to say is, thank you for letting me speak here. I'm sorry I'm not there. I think that as this committee sort of starts looking towards the future, it's going to have to move beyond intentional discrimination to really start thinking about the disparate impact of rates on different communities. Thank you very much.
And thank you. That completes the second part of our presenters. And we now, are there any questions? Yes. Where did Kevin Cahill go?
I'm still here, Mr. Chairman. I'd like to give other people a chance to open the questioning. I don't want to dominate. So if other people have questions, I'd rather defer, but if nobody else does, I'll go.
I designate that you are now up to bat.
Well, thank you. And I'd like to thank all the presenters. Mr. Lynch, all due respect, I just want to start out by telling you it's pronounced publica, not publica. I don't know whether that was intentional or not, but again, there is a hidden message there when you mispronounce something. I live around people who call nuclear all the time, and I hear very regularly about the Democrat Party, where I don't know what that is, the Democratic Party, but I know it's a minor point, but it is significant. I would like to ask you, while you demonstrated that that as a scientific aspect of actuarial science, that there were correlations that could be explained, how do you explain something that reflects about a 10% difference in the distinction of the individual versus 100% interest in the premium? If it were 10% versus 20% or 15% versus 18%, that might be a different story. But what the individual was able to demonstrate was that the study revealed vast differences in premium. So if you could just react or respond to that, I would appreciate it.
Are you referring to the pardon my mispronunciation, Publica?
Yes.
Study?
Yes.
Their study's findings were incorrect.
Yeah, I got that was your impression that they were incorrect, but the analysis from the study demonstrated a disparity between characteristics and premium of 100%, like doubling the premium. So even if there are aspects of it that do not meet the highest actuarial standards, how do you explain that vast difference? Or you say that doesn't exist?
The premiums that are being charged are, as I mentioned in the discussion, those are rates that that insurance companies spend literally thousands and millions of dollars coming up with, and making sure that they obey the laws in every state, and making sure that the rating factors have a statistical basis. And so there are cases where one individual pays a low rate and another individual pays a high rate. And without a thorough examination of the individual circumstances for each person and where they live does make a difference, because the number of cars per square mile is perhaps the greatest predictor of the probability of being in an accident that exists. But there are others that also do a very good job of predicting. And when you put them together, you can have people who are pay vastly different amounts in insurance, but those rates are justified. And you know that they're justified, A, because companies, through things like adverse selection, which was discussed earlier, have a stake in charging the right rate from a marketplace point of view, but then also from a legal and a regulatory point of view, they also have to charge the correct rate. And you know, the individual cases there, you would have to look deeply into what the circumstances were and what the rating factors were for them.
Thank you. I understand in an industry that's based upon averages, looking at individual cases is a little bit difficult, but Mr. Chairman, I would point out that this really does point to the need to go beyond the current model law that's being considered. Systemic discrimination means that if everything works, discrimination occurs, and inappropriate, unlawful discrimination is something that clearly I think needs to be further examined. And if we limit it to the text of the model law, we will never get there. Thank you very much, sir. I would really do appreciate it. I'd like to ask Mr. Carroll a question about the application of the Supreme Court decision that he cited. Is Mr. Carroll still present? I'm looking for his.
I am.
Oh, I'm Carol. Good to see you. I have what I call the Brady Bunch in front of me, and it's always hard to figure out which one of the kids you are, or whether you're one of the parents. My question is with regard to the application of the Supreme Court decision. I apologize for not having read it, and I couldn't scribble down the citation quick enough. It was Texas Department of Community Affairs.
It's I can send you the site, sir, but it's Texas Department of Housing and Community Affairs versus Inclusive Communities Project, 576 US 519, 2015.
Thank you. Just in terms of the application, this was a government agency that was, I'm going to just speculate here, a government agency being sued by a private group. Is that correct? Or was it the government agency doing the suing here?
No, it was a case under the Fair Housing Act that considered how tax credits for developers who built low-income housing units were administered by designated state agencies.
Great. Okay. So it should not in any way be construed as something that would limit a legislature's ability to further define what is illegal or inappropriate discrimination. Would you agree?
No, I said from the beginning that it's not an insurance case, but basically it is a case that cites other cases that are not directly applicable to the facts and circumstances of that case, and basically provides a rule of law that would be looked at by many courts in terms of dealing with this complex legal question.
Thank you. Thank you very much, sir. And I do thank you and your colleague for your testimony. Ms. Bender, you indicated that you had concern that I raised with an earlier witness concerning the flood of data that is available. And perhaps I'm not sure if it was you or a subsequent speaker who pointed out to the potential inability of a legislative body or a government regulatory body to stay ahead of that data. Is that a real concern of yours? And if so, how would you propose that it be viewed or considered in terms of, and I recognize you're here for factual purposes, not policy purposes, but what sort of tools could we use to overcome that massive amount of data that may be beyond our ability to anticipate?
Uh, great question. So I would say that we're posed with this challenge as well to understand, first of all, what data is out there and available, what data we've yet to even begin collecting as an industry. I think that's one of the biggest challenges, to be honest, and many insurers have noted this challenge as well, that we, as Jim mentioned, we don't use race to actually in our rating plans right now, which means being able to actually collect that information to understand what is the true disparate impact or discrimination that's happening is the first step. We don't have that information to test the theories, and it's problematic to use other proxies like zip code or credit score to try and predict race within racial impacts within our data and in our models as well. So that there's a big gap there that we're even now having to understand, how do we fill that gap? I know that's not a complete answer to your question, but I think that's what I'm comfortable saying right now.
Well, it'd be, my question is open-ended because I don't really have an answer either. I'm just looking at questions. Would you agree with Mr. Swerdloff that perhaps, or Professor Swerdloff, I'm not sure, I don't want to ever deny somebody their appropriate title, that perhaps we have to revisit our restrictions or maybe even industry practices on data collection in view of the fact that such a significant amount of new data will be available and that it would become more and more difficult to ascertain what is actually a proxy. Perhaps more data should be collected. That's part one of the question. And the other one I won't even ask you, I'll just assert, if that data is collected, because it's policy, if that data is collected, I'm going to suggest that it may be reasonable to have there be a blind repository for that data that does not abridge proprietary information or put at risk competitive information, but a blind repository where then it could be examined to perhaps influence future policy. So I forget the first part of my question, but I hope you remember it. Guess not. Okay. I guess my question was, do you think we have to open the door to allow the collection of more data?
Is that for me?
No, that's still for Ms. Bender. I'm going to get to you next.
That's what I thought.
Sorry, I thought you had moved on from me. I won't say what I think that public policy makers should do, but I would say that actuaries always welcome the ability to look at more data. So.
Thank you. Thank you. I appreciate that. And I agree with you. I'm always thrilled to talk to the actuaries when I get to go to the meetings and to stop at the table with the great tchotchkes they give away. And I use the pen with the highlighter at the end with great regularity. So thank you for that. Mr. Swerdloff, I was intrigued with your presentation because you really enunciated many of the points that have been of concern to me since the beginning of this. But if you don't mind, I'd like to focus on your last point about the collection of more data and how we do so in a responsible way that does not infringe upon the ability of companies to continue to compete in an increasingly competitive environment.
I mean, I think, to be fair, I don't have answers to that particular question. I'm sure that there are ways to provide lost data that then gets aggregated together by the commissions, by the commissioners, and then is aggregated across multiple insurers, and so that third parties can use it, as you say, in a blind repository. More than that, I don't think I have any novel suggestions. I think
again, both on your point and Ms. Bender's point about this avalanche of data that is now available. And, in one of the earlier presentations, it might not have been here. It might have, I think it was here though, where someone talked about the voluntary submission of the way you drive by signing on to a policy that allows you to look at a computer. I mean, that's the micro analysis of data that we've addressed in other meetings. If we cannot stay ahead of the factors leading into a determination that might be perceived as a proxy for illegal discrimination, might it be appropriate for us to start to simply blanket prohibit a discriminatory impact and require our insurers to start looking at that end of the equation instead? I'm asking you just as a matter of in the context of your analysis, not as a suggested model law for Mr. Breslin to take up here.
Right. I mean, so several things. I mean, one is there are a lot of issues that you raised. I mean, so for instance, if people have telematics devices in their car, there are all sorts of questions about who owns that data and privacy issues, but that's not what we're here for. And you know, what I was asked to talk about today, and I'm happy to come back at other times and talk about more things, because I've been thinking about these issues in a wide spectrum of sort of insurance related issues, is about the risk classification question. And I've written, and I think that states individually or collectively are going to have to ramp up their ability to understand what's going on with new models, with with AI models. It is very difficult to peek under the hood of some of those models. It is possible with machine learning models to understand what are the top, let's say, 5 or 7 factors that are really driving the price. It's not always possible to understand really what's driving all of the price if they're using hundreds of factors. If that's true, then the kinds of regulation, the kinds of rate regulation that have gone on in the past might be undermined in ways that would require us to think a little bit more carefully about using disparate impact as a regulatory tool, as you say. And to do that, I think, as I said, is going to require some very hard thinking about what do we care about and when. And that's the work that the legislatures will have to engage with, I think.
Thank you very much. Mr. Chairman, I would just want to make one sort of editorial comment about the process here today. We had a member of one panel make a presentation, and then we had a member of another panel assert a point-by-point refutation of that. In the future, I believe that it would be appropriate to have those individuals on the same panel so that there's a fair opportunity for people to do a rebuttal or a response. But I thank you once again, and I'm hoping I don't speak again, so I applaud you for bringing this forum to us. And I do honestly and sincerely thank each and every one of our witnesses for giving us a level of insight and expertise that we simply cannot possess as legislators. So thank you.
Thank you, Kevin. And any other questions? You know, I think that all of us have learned something today, and we have to now apply it. And it's a difficult process. And I know that during the last number of months, we've had a lot of people who have thought we were moving in the wrong direction one way or another. And I assure you that's not our intention. Our intention is to collect as much information as we can and make some recommendations that will positively affect the people who are buying our policies. And I think we've done a great deal. We've collected a great deal of information today that will be useful to the committee to come up with some recommendations that hopefully will end up at some point with a model law that we can all look at and respect. I'm afraid that might be Tantalus reaching for the grapes in some respects, that we will never, and I see Kevin Kao laughing at my classical. It is, it's a very difficult
Your Jesuit training is coming through.
Right, okay, a disparate meeting. So I don't think our job is done, but I think we've collected a lot of information that will be very useful to us. And I commend each speaker for taking the time today to help legislators achieve some degree of knowledge to make the right decisions in the coming months and years. And that will be done at the same time that there'll be so much more information available each and every day that might have the ability to change our point of view and rotate our point of view on an ongoing basis. So with that, I will conclude.
Chairman, before you get to the with that, I see Senator Hackett's light came on in the room, so if we could hear from Senator Hackett.
Yeah,
Senator Hackett, you're on.
thank you, sir. And Kevin, I totally understand your points. Yeah, and this question, I probably should have asked it in the first half, but it's a question for Mr. Lynch. And some of the frustrations we have as legislators, the one professor or the gentleman from the University of Connecticut Law School talked about the unfairness of looking at criminal records. And if you look at even in the Republican states, we have pushed hard to try to get records erased because we want to get people back to work. And even some of the strongest Republicans that have changed have gone 180 degrees because they realize getting people back to work. So the question is, and I ask, because I'm somebody that believes strongly in that I think insurance companies use loss ratios very strongly. And so question I have, Mr. Lynch, I know that the one gentleman would like to probably get rid of that type of in the underwriting of using criminal records. But my question on that is if we're moving towards that, we're getting the less serious records moved out or erased or whatever, and that the records that are staying left are more serious records, isn't the loss ratios from that underwriting of criminal records, doesn't it pretty well speak for itself that the loss ratio is there that causes, it's important to keep that as an underwriting? So that's the only question I have for Mr. Lynch. And if the other gentleman's on from University of Connecticut, that's the only question. But we have moved. And I know, especially in Ohio, that now we do things when I first started, we would never have done because these people would never allow us to steal records on people that had even first-degree felonies and different things, et cetera. So that we want to get people back to work, and we realize they won't get hired if they have a certain type of criminal record and it's barely, might be a first offense or whatever. So that's a question I have is what's his reaction to the scenario where we're taking off, the part of criminal records that is probably the easiest part of criminal records that we can protect, and the more serious criminal records are staying on. Shouldn't we stay in that underwriting scenario situation? Because I know that was the argument of the gentleman from University of Connecticut.
I haven't.
I'm here if you want me to.
Oh yeah, go. You see what the point I made? Because we have moved strongly in a lot of states where now we hide records and we erase records, et cetera. So it is clear. But the question I wanted the other gentleman to say is, well, what is the loss ratio? I mean, what are the insurance companies finding out? Because it's in the media, it's in the news media all the time, with DNA and everything that maybe people. But you talk to the judges, and you talk to law enforcement, and you talk. I still think it's a credible underwriting principle. So that was the only question, and we are moving away from, the records that we're trying to get people back to work. So we're trying to hide those records on a lot of people.
I haven't.
Jim Lynch, you want to respond?
Sure. I haven't seen a lot of research about the particular variable that that Peter was talking about, and I just don't have a lot of information to what degree it's used. I don't have a lot of information about how it's weighted, but I think there's a general question that you ask, and I think it's an interesting one and an important one to ask. If as the analysis of the state of Missouri and the analysis that we saw with Illinois and Texas and what the California regulators looked at, that says that the rates that are being charged are appropriate given the risk profiles of the individuals who are being charged those rates. If you alter that mix, depending on which variables you prohibit, it could well have an impact. And I think that is on rating. And that's one of the things that does need to be studied. And I think if you think a bit about what Malika was talking about, some of the research that she was discussing actually starts to get at that. You know, what is the impact of a variable that's been excised? You know, I've been in the insurance game long enough that I know that there have been some efforts 30 years or so ago to place restrictions on the use of territory rating variables, and that didn't work out particularly well either for the insurance industry or for their customers. You had a severe availability and affordability problems, and I happen to live in New Jersey, which was virtually ground zero for that entire problem. So there can be extreme impacts, and it's something that definitely needs to be taken into account when you contemplate these things. And that's why, like I said before, you need research, and that research, we would recommend that it's done by organizations that have a long-standing ties in the insurance industry, or organizations like the Casualty Actuarial Society and some of the other ones I mentioned, and some other folks have talked about as well.
Anybody looking to
Do you want me
respond?
address, or
Peter Krogenberg, yes.
I don't mean to interrupt. Did you want me to?
No, I'm saying that to go right ahead.
Oh, okay, thank you. No, I mean, I actually sort of agree with both. The gentleman from Ohio, those efforts to, you know, decriminalize some, you know, both in the sense of erasing criminal records when appropriate, as well as making less of minor offenses criminal. Those are very important and go well beyond, of course, the value to insurance underwriting. And I also agree that understanding more the effect of criminal records on underwriting and how predictive they are is also pretty important. But I think, and this gets back to the discussion we had earlier today, or the presentation from the gentleman from Canada, in which the Supreme Court there was saying there aren't other, you know, there really doesn't seem to be other practical substitutes for the use of gender there. Well, now we're, you know, years later, light years later in terms of progress, and we're using dozens or hundreds of risk factors. And the fact that we might lose one that is predictive, and let's assume it's predictive as it may be, we lose one that's predictive, 1 out of 200. What does that mean? Does not mean, certainly doesn't mean insurer insolvency, and it may not even affect the risk pool. And ultimately that decision, and we make those decisions all the time, right? Pre-existing conditions are, of course, highly predictive of cost, but we don't allow them for higher principles. Race is predictable, predicts some aspect of insurance. We don't allow that either. But so it's 2 points. One, given you know, the faded and bad, you know, nature of criminal justice system, both in the number of people it penalizes and how, and the fact that there are so many other factors that are increasingly predictive, that in me argues that yes, to study it, but also even if actuarially justified, is it necessary to get accurate rates? Thanks.
Okay. Anyone else? Okay. I will now declare our conversation over with, and we will have a little discussion. Is that right, Tom, among the committee members?
Yes, Mr. Chairman, if it pleases the chair, there's certainly going to be some discussion among the chair. I just don't want to leave the impression that the committee's going to have a meeting kind of behind closed doors. So there'll be a next steps discussion, and then if there's a further meeting, obviously that'll be
right. Just next steps, not a substantive discussion.
Right.
Great. That'll start in 5 minutes.
No, I'm sorry. What's on the agenda was open discussion among the committee members here. Now,
Oh, another date. Yes. Okay.
right. So now this is an opportunity in case anyone has anything else they wish to discuss today.
I will now declare this meeting to be over.
Right. Thank you, Mr. Chairman.
Thank you. And thank all the participants.
Thank you.
And for those people in Charleston, enjoy it.